Last month, I had breakfast with a central bank governor from a G7 country. I can't tell you which one, but this person oversees hundreds of billions in reserves. We were discussing portfolio allocation, and they said something that stopped me cold. Ray, we're buying gold at $4,100 an ounce, levels we never imagined 5 years ago. Not because we want to, because we have no choice. The system is breaking down, and when it does, gold is the only asset that survives the transition. This wasn't some gold bug conspiracy theorist. This was a sophisticated policymaker with access to data most people will never see, and they're terrified.
Right now, gold is trading around $4,100 per ounce. It's up 54% in just 1 year. The mainstream narrative says it's overvalued, overbought, due for a correction. JP Morgan analysts are warning clients about pullback risk. Retail investors who missed the rally from $2,700 are waiting for a crash to buy in. They're all wrong, dead wrong. I know because I've been here before. In October 2008, I'm sitting in my office at Bridgewater, watching the financial system implode. Lehman Brothers just collapsed. AIG is next. The S&P 500 is down 40% from its peak. Every single client is calling asking the same question. Should I sell everything and go to cash?
I told them something different. Buy gold. As much as you can afford. Gold was trading at $730 per ounce. They thought I was insane. Ray, the world is ending. We need safety, treasuries, cash, not some barbarous relic. I explained the same thing I'm going to explain to you right now. When the financial system breaks, when governments print trillions to prevent collapse, when debt spirals out of control, there's only one asset that preserves wealth: gold. 3 years later, gold hit $1,900, a 160% return, while stocks barely recovered. The clients who listened made fortunes. The ones who didn't spent a decade just getting back to break even.
Now here we are again. Different crisis, same pattern, same solution. Except this time, the debt is 10x larger. The money printing will be 10x bigger, and gold's move will be proportionally more dramatic. I've spent 50 years studying how economic machines work. I've analyzed every major currency collapse, every empire transition, every debt supercycle in recorded history. And everything I see right now tells me gold at $4,100 isn't expensive. It's still cheap, dramatically undervalued, and it's heading to $10,000 per ounce within the next 3 to 5 years, possibly much higher. This isn't speculation. This is pattern recognition based on studying 500 years of monetary history. We're in the late stage of a long-term debt cycle colliding with a fundamental shift in the world order. And in that environment, gold doesn't just preserve wealth, it multiplies it exponentially. Here's what I'm going to walk you through. First, where we are in the debt supercycle and why currency debasement is mathematically inevitable. Second, the geopolitical earthquake driving unprecedented central bank gold buying even at record prices. Third, why the traditional arguments against gold are dangerously outdated. Fourth, the specific catalysts that will propel gold from $4,100 to $10,000 and beyond. And finally, how to position yourself before the next leg of this historic bull market. Because I promise you, when this wave accelerates, it will move faster than anyone expects, and the people waiting for a pullback will watch from the sidelines as gold doubles again, then potentially triples from current levels. The machine is breaking down, and gold is the only asset that survives the transition intact.
Let me tell you about a meeting I attended in early 2009, right after I called gold correctly. I'm in a room with Treasury officials and Fed governors. The immediate crisis has passed. Lehman is gone. The system stabilized temporarily. But now we're facing the consequences. The question on the table, how do we unwind these emergency measures without destroying the dollar's credibility? The answer everyone settled on? We don't unwind. We can't. The debt is too large, the economy too fragile. We print massive amounts of money gradually, export the inflation globally through the reserve currency system, and pray we can buy ourselves more time before the next crisis. I remember sitting there thinking, this is the moment. This is when they chose inflation over default. And that choice makes gold the single most important asset to own over the next decade. I was right then, and I'm right now.
Fast forward to today. We didn't deleverage after 2008. We added more debt. Then COVID hit, and we printed $6 trillion in 18 months. The national debt just crossed $38 trillion in October 2025. That's $2.2 trillion added in fiscal year 2025 alone. We're adding debt at a rate of $5.95 billion per day, $248 million per hour, or $68,902 per second. Read that again. Every single second, the U.S. government adds almost $69,000 to the national debt. This is late-stage debt cycle behavior, and there are only 3 mathematical ways out.
Option 1. Austerity and deflation. Cut spending 30–40%. Accept a depression. Let debt defaults cleanse the system. Politically impossible in a democracy. No elected official survives proposing 30% unemployment and social upheaval. Option 2. Outright default. Tell bondholders they're getting 50 cents on the dollar. This destroys your credit permanently. No one lends to you again at reasonable rates. America won't choose this while the dollar remains the reserve currency. Option 3. Inflate it away. Print money. Debase the currency. Reduce the real burden of debt through sustained inflation. This is what every empire in history has chosen when facing this crossroads, and it's what America will choose again. But here's the critical insight most analysts miss. We're not just talking about U.S. debt. Global debt stands at 350% of global GDP. The entire developed world faces the same mathematical trap. Europe, Japan, China, they all have debt problems solvable only through coordinated currency debasement. When everyone prints simultaneously, you get competitive devaluation, a race to the bottom. And in that race, hard assets with strictly limited supply become exponentially more valuable. Gold represents the ultimate hard asset with the most constrained supply. Only 187,000 metric tons have ever been mined in all of human history. Annual mine production runs about 3,500 tons, roughly 1.6% supply growth. You can't QE gold into existence. You can't digitally create it with keystroke entries. You can't repo it overnight to meet reserve requirements. When currencies are being debased at 10–15% annually through money printing, real inflation, not CPI fiction, and gold supply grows at 1.6%, the mathematics are inexorable.
Gold must rise in currency terms just to maintain relative scarcity. And when debasement accelerates, gold doesn't just keep pace, it surges violently. I've studied the Weimar Republic. I've studied every Latin American hyperinflation. I've analyzed Zimbabwe, Venezuela, Argentina. Gold always, without exception, soars in local currency terms during debasement periods.
Now, I'm not predicting Weimar-style hyperinflation for America. We're not there. But we are headed for sustained 5 to 8% real inflation as the only politically viable path to reduce debt burdens. And in that environment, gold's trajectory is clear and powerful. The Federal Reserve understands this dynamic perfectly. That's why they stopped fighting inflation aggressively in 2024. That's why real interest rates, nominal minus inflation, remain barely positive or negative. They need inflation to erode the real value of that $38 trillion debt mountain. And gold's 54% surge in the past year is the market's verdict on their strategy. Here's what's happening beneath the surface that mainstream media completely misses. We're witnessing the end of the dollar-centric post-Bretton Woods order. Not someday, not in theory, right now, in real time. Let me give you numbers that should terrify anyone holding 100% dollar-denominated assets.
Central banks purchased 634 tons of gold in the first 9 months of 2025 alone. That's down from the extraordinary 2022-2024 levels, but still dramatically above historical norms. Between 2010 and 2021, central banks averaged 473 tons annually. We've now had 15 consecutive years of net central bank buying. And here's the crucial detail everyone overlooks. They're buying at record high prices. September 2025 saw 39 tons of purchases, a 79% month-over-month increase, despite gold trading above $4,000. Third quarter 2025 witnessed 220 tons flowing into central bank vaults. Who's buying? China, Russia, India, Turkey, Poland, Kazakhstan. These aren't random countries. These are nations systematically building alternatives to the dollar system. World Gold Council surveys reveal extraordinary confidence. 95% of central banks expect global gold reserves to increase over the next 12 months. And critically, 43% plan to expand their own holdings, while 0 respondents expect reserves to decline.
Think about that. Central bankers have access to the best economic data, the most sophisticated models, direct communication with other central banks, and they're unanimously bullish on gold at $4,100. That's not sentiment. That's strategic repositioning for a post-dollar world. I was in private meetings with Chinese policymakers 8 months ago. They were remarkably candid. We don't want to collapse the dollar system tomorrow. That would hurt us. But we're building insurance. We're creating alternatives because American policy has become too unpredictable, too weaponized. And they're right. When America freezes Russian dollar reserves, when we impose secondary sanctions on countries trading with adversaries, when we use SWIFT as a geopolitical weapon, we're teaching the entire world that dollar dependence is a strategic vulnerability. So what are they doing? Building systematic alternatives. The BRICS payment system is operational. Digital yuan infrastructure spans 140-plus countries.
Currency swap agreements eliminate dollar intermediation in bilateral trade. And gold, physical gold held in sovereign vaults, represents the ultimate reserve asset that no government can sanction, freeze, or devalue through printing.
This represents the most significant geopolitical shift since Bretton Woods in 1944, and gold stands as the primary beneficiary. Here's why this matters for prices. When central banks were net sellers, 1990s to early 2000s, gold languished below $400. When they became net buyers after 2008, gold rallied from $800 to $1,900. Now they're buying at the fastest sustained pace in modern history. And unlike retail investors or hedge funds, central banks don't panic sell on 10% corrections. They accumulate systematically for decades. This creates a structural bid under gold that didn't exist in previous cycles. It's persistent one-way flow, continuous buying with zero intention to sell. That's the textbook definition of a secular bull market.
Let me tell you about a conversation I had in 2011 with the CFO of a major pension fund. I won't name them, but they managed $80 billion for state employees. We were discussing asset allocation strategy. I recommended they allocate 10 to 15% to gold. It was trading around $1,600 at the time. The CFO looked at me like I'd lost my mind. "Ray, gold produces nothing. No dividends, no cash flow. Our actuaries require 7.5% annual returns. Gold doesn't generate that. We're putting everything into stocks and high-yield bonds." I tried explaining the insurance value, the portfolio diversification, the protection against currency debasement. They wouldn't listen. We ran the models. Gold underperforms over long periods. This is settled science. Fast forward to 2025. That pension fund is now underfunded by 35%. Their stock-heavy portfolio got crushed in 2022 when inflation spiked and both stocks and bonds fell simultaneously. Their high-yield bonds defaulted during the regional banking crisis. They're facing benefit cuts and considering bankruptcy. Meanwhile, if they'd allocated just 10% to gold in 2011, that position alone would be worth nearly 3x today. At $1,600 then, $4,100 now. That 10% allocation would have saved the entire fund. Thousands of retirees would have secure pensions instead of facing 40% benefit cuts. This is the cost of not owning gold. It's not just missed upside, it's catastrophic failure when the system breaks, and the system is breaking right now. That CFO called me 6 months ago. "Ray, you were right. I should have listened. What do I do now?" I told them the same thing I'm telling you. It's not too late. Gold at $4,100 is going to $10,000. The wave is just beginning. Let me systematically dismantle the standard arguments against gold, because understanding why conventional wisdom fails is critical to positioning correctly. Argument 1. Gold produces no cash flow. It's unproductive. This is the Warren Buffett critique, and it's valid in a stable monetary environment with sound currency and reliable growth. But we're not in that environment anymore. When currencies are stable and productive assets compound reliably at 7 to 10% annually, yes, you want businesses over gold.
But when currencies are being systematically debased, when $38 trillion in debt grows $69,000 per second, when governments have no mathematical path to solvency except inflation, gold's lack of counterparty risk becomes its greatest strength.
Gold has no cash flow, but it also has zero bankruptcy risk, no default risk, no management incompetence risk, no political expropriation risk. It represents pure monetary value with 5,000 years of unbroken history as the ultimate store of wealth. From 2000 to 2011, gold outperformed the S&P 500 by over 400% as currencies were debased. From 1970 to 1980, gold surged 24x while stocks went nowhere. In both periods, currency debasement made productive assets worth less in real terms while hard assets soared. We're entering another such period, and clinging to the gold produces nothing argument will cost investors their purchasing power while gold holders preserve and multiply wealth.
Argument 2. Gold has risen too far, too fast. It's in a bubble. Gold is up 54% in 1 year. Sounds dramatic, right? Now examine Nvidia, up 800% in 18 months. Tesla, up 400% from 2023 lows. Bitcoin surged 300%. Those represent speculation-driven bubbles. Gold's move reflects rational monetary debasement response. And measured against money supply expansion, gold remains undervalued. M2 expanded 40% since 2020. If gold merely kept pace with money printing, it should trade around $4,500 to $4,800 based on 2020 levels. At $4,100, we're still below monetary inflation parity. The real bubble? Sovereign debt trading at 3 to 4% yields when real inflation runs 6 to 8%. Negative real rates across developed markets. $38 trillion in U.S. debt that can never be repaid in sound currency.
Argument 3. Central banks will stop buying at these elevated prices. The data directly contradicts this narrative. September 2025 purchases surged 79% month over month. Q3 2025 saw 220 tons flow into vaults. The 15-year buying streak continues unbroken. Central banks aren't buying for quarterly returns. They're repositioning reserves for the next 50 years of geopolitical reality. If the dollar loses 30 to 50% of reserve status over the next decade, which I project as highly probable, gold at $10,000 to $15,000 will appear cheap in retrospect. They're not trading, they're structurally rebalancing for a post-dollar hegemonic world. That process is accelerating, not decelerating. Let me outline the specific drivers that will propel gold from current levels to $10,000 plus over the next 3 to 5 years. The Fed will restart quantitative easing within 12 to 18 months, not by choice, by mathematical necessity when recession hits or Treasury auctions fail to clear due to insufficient foreign demand. When QE restarts, it won't be $100 billion monthly like 2020. It'll be $200 to $300 billion because the debt burden is vastly larger. And this time, ECB, Bank of Japan, and other central banks will coordinate simultaneously.
we'll witness global money printing at scales never before attempted. Historically, every $1 trillion in new money creation adds $200 to $400 to gold prices. If we see $5 to $7 trillion in coordinated global QE over 2 to 3 years, that alone justifies gold reaching $6,000 to $7,000.
As the dollar's share of global reserves drops from current levels toward 40–45% by 2030, central banks must fill that massive gap. The alternatives are euros, also being debased, yuan, not fully convertible, and gold, universally accepted, zero counterparty risk. A shift of just 10 percentage points of global reserves, $1.2 trillion, from dollars to gold would require purchasing 15,000 tons. Annual global mine production is only 3,500 tons. The mathematics demand dramatically higher prices to clear that demand. Right now, most Americans believe 3 to 4% inflation is temporary. Once they internalize that government needs sustained inflation to manage debt, psychology shifts violently. When the public realizes dollars lose 6 to 8% purchasing power annually by design, they'll rush to hard assets. We witnessed this in the 1970s. Gold surged 24x in a decade, largely because Americans understood inflation wasn't transitory. When that recognition hits this cycle, with 10x the money supply and 100x the debt, gold's move will be proportionally more dramatic.
Some event in the next 2 to 5 years will trigger a sovereign debt crisis. Perhaps Japan, when yields rise above 2% and interest costs become unsustainable. Perhaps UK gilts breaking again like 2022. Possibly even a U.S. debt ceiling crisis causing technical default. When the first domino falls, capital won't flee to other sovereign debt. All face identical problems. It will flood into gold, the only major asset with zero counterparty risk and millennia of monetary trust. Official data shows China holds 2,264 tons. Independent analysis suggests the real number could be 10,000 to 30,000 tons based on import flows and domestic production that never appears in exports. If China reveals they've quietly accumulated for 15 years and now hold more gold than the U.S., that triggers instant global reassessment of gold's monetary role. Prices could surge 50+% in days. Layering these catalysts over 3 to 5 years, $10,000 gold isn't optimistic, it's conservative. Certain scenarios, major war, sovereign default, China announcement, could drive prices to $15,000 to $20,000.
Here's how to capitalize on this historic opportunity. First, own physical gold. 15 to 25% of liquid net worth minimum. Bullion, coins, allocated storage, not paper promises. Second, select gold miners strategically. When gold rises from $4,100 to $10,000, mining profits don't merely double. They multiply 10–20x because costs are relatively fixed. Quality producers like Newmont, Barrick, Franco-Nevada will dramatically outperform. Third, diversify across hard assets. Gold anchors the portfolio, but also owns silver, currently at 80-to-1 ratio, historically closer to 50-to-1. Energy assets, productive farmland. Fourth, minimize long-duration bond exposure. When inflation accelerates, bonds get destroyed. Short-term treasuries acceptable for liquidity. Long bonds represent wealth destruction. Fifth, monitor leading indicators religiously. Real rates, central bank purchases, dollar index, gold-silver ratio. These signal where we are in the cycle.
I've spent 5 decades analyzing empire transitions. Rome, Spain, Britain, the Dutch Golden Age. The pattern repeats with mathematical precision. Overextension, debt accumulation, currency debasement, loss of reserve status, violent wealth transfer to hard assets. We're watching the American empire navigate this cycle in real time, not because of American failure, but because the mathematics of compound debt are inexorable, and every empire eventually faces identical choices. In 2008, I told clients to buy gold at $730. They thought I was crazy. Gold went to $1,900. I was right. Now I'm telling you to buy gold at $4,100. And I'm even more confident this time, because the debt is 10x larger. The geopolitical fragmentation is accelerating. The central bank buying is unprecedented, and the catalysts are lining up perfectly. Gold isn't rising to $10,000 because of speculation or mania. It's rising because 5,000 years of monetary history demonstrates that when fiat currencies are systematically debased, hard money assets violently reprice to reflect the new reality.
That central bank governor I met last month, they bought gold at $4,100 not to diversify a portfolio. They bought because they've seen the confidential data on debt trajectories, reserve flows, and geopolitical fragmentation. And they know what's coming. That pension fund CFO who ignored me in 2011, they're facing benefit cuts and bankruptcy because they didn't own gold. Don't be them. When the people running the system are preparing for its structural transformation, you should be too. The machine is breaking down. The debt supercycle is ending. The world order is shifting. And gold represents the asset that not only survives the transition, but thrives dramatically. I've studied this pattern across centuries of history. I called it correctly in 2008. And I'm calling it again now with even greater conviction. Gold holders will preserve and multiply wealth. Fiat currency holders will learn economics' most expensive lesson. The wave is building. When it crests, $10,000 will seem conservative, and the people who waited for a pullback will realize too late that the pullback already happened. It was from 1900 in 2011 to 1200 in 2015. That was your chance. This is your second chance. There won't be a third.